Hey everyone, thanks for checking out this video. My name is Travis Rose. I'm the creator of the Master the Market education that you can find linked down below in the description. And this is going to be part 5 of the Day Trading Stocks for Beginners series that I'm doing here on my channel. So if you're brand new to the market, I do recommend probably starting off by watching the first 4 parts. And I'll have those linked down below in the description so you can go ahead and get started with those. But anyway, in the last 2, we started talking a little bit about the basics of technical and fundamental analysis. So pretty soon, if you're not already trading and you're just studying, I would imagine you're probably going to start trading pretty soon. So with that being said, in this part of the series, I want to talk about something that most people tend to kind of overlook when they get started with their trading, and especially when they start paper trading. For those of you who don't know, paper trading is just trading with fake or virtual money, and it's a way for you to practice your trading before you invest real money. But by doing that, you're actually missing out on a big part of the trading, which is the psychology and the emotional aspect. So with that being said, I want to talk a little bit about trading psychology. Believe it or not, trading involves a ton of psychology and a ton of emotions. In order to trade successfully, it's important to be able to control your emotions and place your trades based solely on things like your strategy and your overall risk in the market. So if you think about it, one of the major advantages of trading algorithms is the ability to trade completely based on strategy with no emotions. If you go anywhere on Wall Street, you look into any hedge fund or any institution, they're going to be using trading algorithms, which are essentially computers that place their trades for them. And again, that's going to completely take the emotion out of trading. And that's one of the reasons that they have such a big advantage over us retail traders. Obviously, the other aspect is the ability for them to place their trades at very quick speeds, but also having no emotions to get in the way of their trading strategies is another huge advantage. So some of the main psychological things and emotions that we feel when we're trading, one of them is greed. We all know greed, and we've all probably experienced greed at some point within our lives, especially those of us that have been trading. And greed is something that can take over very easily when you're in a profitable position, but you're not exiting because you want more on that trade. It can be very difficult for us to not get greedy because at the end of the day, all of us are in the market for the same reason. We want to make as much money as we possibly can. So a lot of times with that mindset, of course, is going to come greed. One tip that I have to kind of help you avoid getting greedy is to avoid looking at your unrealized P&L, which is your unrealized profit and loss. And that simply tells you how much you're going to be quote unquote up or quote unquote down on the trade before you exit out of it. And by doing that, for example, maybe you were up $100 in a position and you were looking at your unrealized profit and loss. Then later on, you checked back in and you were only up $50 on that position. So a lot of times you get into that mindset at that time that you're going to sell as soon as your profit gets back up to $100 because that's where it was before. Even though if you were looking at the chart and you were basing your trade on the strategy, the market would be telling you to probably just take your $50 in profit and move on from the trade. So if you're not looking at your unrealized profit and loss, that's going to help you trade based solely on your strategy and solely on the chart, and is going to help you put your emotions to the side because you won't be worrying so much about how much you're going to be up or how much you're down on the trade at any given time. Now, one very important thing about greed is that letting your winners run is very different from actually being greedy. So if you're in a trade, for example, and everything is going perfectly according to plan, then there's obviously nothing wrong with continuing to hold to make more money. The thing is that greed comes into play when you continue holding, even though the trade is no longer following your trade plan. So just to give you a little bit of a visual on what that may look like, if we take this example, we have the stock AIM and we're looking at the 5-minute chart. So that just means that each of these candles is representing 5 minutes of price action, and we're looking at an entire day. So let's say in this example, you were going to buy into the stock right there at the white dot, just about in the middle of the chart. If you see right after that white dot, right when you're buying the stock, in the very short term after that, it has a pretty strong move up and pretty consistently trends higher and higher until there's a major reversal in the stock. So the point that I'm trying to make is that you're not going to be greedy by holding through this steady climb in the stock because it's still moving according to your plan and because it's still moving consistently and steadily. But of course, greed is going to come into play if you were still holding the stock later on when it's starting to actually make lower lows and lower highs and is now reversing into kind of a downtrend. At that point, the chart and pretty much everything is going to be telling you that it's time to sell out of your position and lock in any profits that you have left. But a lot of times that's where greed kicks in And that's where people say, I was up $100 just a little bit ago. I'm just going to continue holding until I'm up $100 again. And this time I'm going to sell there and lock in my profits. The thing that happens though many times in that case is they never get back to that $100 in profit. And from there, they watch their winning trade turn into a losing trade. The next emotion that comes into play a lot of times with trading is called FOMO, or in other words, fear of missing out. Fear of missing out happens when you're not in a trade, but you feel like you're missing out on profits. So at some point or another, we've all probably experienced a little bit of FOMO at some point in our life, not necessarily trading. For example, if you maybe had a group of friends that were planning on going out on a Friday night and they asked you to go out, but you were busy doing some work or getting something else done, you probably have experienced some kind of FOMO or fear of missing out because you don't want to miss out on any fun that your friends are having without you. And really, that's the same thing that happens with our trading. If you're not in a trade and you see all these other people, especially on social media with Twitter and Instagram, Facebook, and all these different social medias, you're seeing people make these trades and make these profits. And because you're not in a trade at the time, a lot of times you can experience FOMO. And more often than not, that FOMO is going to lead to a forced trade and an unnecessary loss. So my recommendation to avoid FOMO is bright and early in the morning when you're creating your watch list or you're scanning the market and preparing yourself to do some trading for the day. If you don't see any stocks that meet your criteria for whatever type of trading strategy that you're personally using, I recommend just closing down your computer and shutting down any trading apps that you have open on your phone, because that's going to keep you from getting FOMO and it's going to keep you from placing any trades that aren't necessarily A-plus trade setups. And really, this is going to help you take the quality over quantity approach to your trading. And by doing this, you're only going to be trading setups that are giving you the highest probability of making a profit. The next psychological thing involved with trading is what is known as revenge trading. Revenge trading is when you force a trade after taking a loss in hopes that you're going to be able to make back that trading loss. It's very easy to become greedy after a revenge trade because you may have a number, like for example $200, set in your mind to recover your previous loss. And when you have a number like that set in your mind, if you were in this case up maybe $100 on the trade, and your strategy and the market and everything is telling you that it's time to exit out of the trade and lock in your $100 in profit, a lot of times traders will get greedy and they'll continue holding in hopes that they'll make back their full $200 loss on this single trade. And that can, unfortunately, for many traders, be the start of a losing streak. So just to give you an idea of how you can better handle losses rather than revenge trading, I actually have a blog post about this, and I recommend going down below in the description and reading this in its entirety after you finish this video, but I just want to go through some of the main things that I shared within this blog. So the first thing is, instead of revenge trading after a big loss, it's best to just take a break from the market. If you take a break, that alone is going to keep you from revenge trading, and it's going to give you some time to clear your mind after your loss. While you're taking a break from your trading, I always recommend traders to kind of fully accept their responsibility for their loss. And what that means is basically that it's important for you to understand that it's not going to help you at all as a trader to blame your losses on something like quote unquote market manipulation or quote unquote the fact that the company you're trading is a scam. At the end of the day, things like market manipulation and scam companies are really just a part of the market, and it's still going to be up to you to place trading decisions based on that information. So while you're taking a break from your trading after a loss, I think it can be very beneficial to write down some notes, taking responsibility for your losses, and say what you could have done better on that trade to avoid taking that loss entirely. Some of the things that I always find myself writing down after a large loss are the fact that I should have caught losses much sooner and that I had way too large of a position in the first place. Okay, and at the end of the day, there are plenty of different ways to handle losses in the market, but one of them should never be to actually revenge trade. Okay, so I hope that gives you a little bit of an understanding of how important emotions and emotional control can be while trading. Obviously, things like trading psychology and emotion are kind of difficult to teach, and at the end of the day, a lot of these things you're going to have to experience on your own. But regardless, I do think some of the tips in this video should help you with things such as getting greedy and avoiding revenge trades. Anyway, if you enjoyed, please make sure to give this video a like and subscribe to the channel so you don't miss out on part 6 of the series. And as always, if you want to learn everything step by step for day trading, swing trading, and even longer term investing, including the exact strategies that I use to trade stocks full time, you can visit the first link down below in the description to go to my website, Master the Market. And on there, we have education, practice tests, and even access to our chat room with over 1,000 active traders. So I highly recommend checking that out if you're serious about taking your education to the next level. But anyway, thanks again for watching the video. I hope you enjoyed, and I'll see you in part 6.